Welcome to the Economic Impact. Once again, a lot of news and a lot of new variables in the economic environment. Stéfane, can you tell us a bit more about what's going on again, especially in rates?
Yeah, but I just want to come back to what you said last month, that the U.S. debt default was unlikely, and you were absolutely right on that. But with this uncertainty having lifted, the central banks are back in action, and we saw the Bank of Canada surprising markets early in June with another rate hike after a pause of roughly 4 or 5 months, right? So, Denis, best guess is that they won't be alone hiking rates in the next few months. So expect these central banks to continue to, bring interest rates a little bit higher. I don't think the increases might be modest, Denis, but there's more in store. Mm-hmm. And more importantly, rate cuts are not going to happen this year, which the market was actually pricing just a few weeks ago, right?
Yeah, it's a totally new environment with what the Bank of Canada just did a few days ago. But at the same time, the economy is going quite well in Canada if you compare it to the U.S. And it's maybe one of the reasons why the bank rate hikes.
Yeah, you can justify it like that, Denis. And clearly, I won't dismiss the data. The data is the data. It's up 3%. Growth in Canada, actually outperforming the U.S. After a mediocre performance the previous quarter, but still, it was an unexpected rebound. Consumer spending was super strong, 6%, and that was on the back of a significant depletion of the savings rate. So the savings rate is suddenly back to its pre-COVID levels. So this is how consumers were able to support the economy, depleting their savings rate.
Mm-hmm. And at the same time, the inflation keep going up. Well, but it depends how you look at it.
Yeah, you're right, but of course. But one thing is sure, if you deplete your savings rate to spend more, obviously prices are not going to come down. And what we're realizing on both sides of the border is that the price level for core inflation, so the level of prices is still well above its 2% trend on both sides of the border, particularly in the U.S., but you could argue the same thing from a Canadian perspective. So clearly, the Bank of Canada was frustrated by this resilience on the inflation front. And this is a global phenomenon, Denis.
Yeah, and there's a new variable that is hitting the market that we're not expecting. This is, residential sales are popping up.
Yeah, well, historically, when you raise interest rates, residential sales go down, but they've been surprised by the surge in recent months, the upturn, and home prices are no longer falling, and they thought they were going to fall a little bit more. So it's putting more pressure on inflation. But Denis, there's not much the Bank of Canada can do at this point in time because this is essentially driven by surging population growth. This year, again, Denis, we're looking at, adding 1 million people to the economy. Unless supply increases dramatically, you're going to have upward pressure on prices, hence the Bank of Canada's decision that we need to hike a little bit more and see what happens thereafter.
Mm-hmm. Demand is there, but I don't think the construction is there. This is the interesting part of where we are in the economy right now. Builders are kind of scared about the future interest rates, and then they're just slowing down, the what we call the mise à chantier,
Housing starts are just not there. You're absolutely right, Denis, but just to give you a sense of how bad it is, the first quarter was the 4th consecutive quarter where we had a double-digit decline in residential investment or home construction. That's the worst performance since 1995. So demand is super strong, but supply is just not there. So, we need to do a better job of matching supply and demand. And until that's done, well, the Bank of Canada is in tightening mode.
Yeah, and then also price increase, inflation increase, and then you're in a spiral, keep going on. But at the same time, we have the stock market that is saying that the economy is going well.
Well, what's just surprising right now is with the debt ceiling uncertainty having lifted, the stock market is saying, well, we're all gung-ho, the economy is going to do well, and the stock market is actually up 6-7% since the debacle of some U.S. banks back in March. So it's a surprising increase in equity markets.
But it's very concentrated.
Diffusion is bad, Denis.
Yeah.
You're right. And it's all in IT or communication services. Anything that's associated with artificial intelligence, AI, is benefiting from a very substantial increase in PE expansion.
That's why we need to be careful about the economy if we just look at the stock market, because that doesn't represent the real economy.
Don't be fooled. Yeah, you're absolutely right. Diffusion is not good. And just maybe to come back on when we started working together at the end of the 1990s, there was a time back then where people were saying that the TMT sector is insensitive to higher interest rates, so anything related to a technology will do well in a higher interest rate environment. And back then, the valuations surged to levels that had never been seen before. Right now, all we can say is that we're back to valuations at 36 times forward earnings or 38 times, something we had not seen since interest rates were at 0% during COVID. So clearly this multiple expansion, despite the rise in interest rates, needs to be watched carefully.
Yeah, the price earning on those stocks is high, but the revenue is not there. It's not following.
Well, it's interesting to see that the valuation is rising. So the IT sector now accounts for roughly 33% of the valuation of the
If you go
stock
back then
market.
2000, what was the comparison?
44%. 44%.
And we're not that far.
We're at 32, yeah. So there's still some upside if you want to bring back the 1990s. So I can't say that speculation can't go higher. But you're absolutely right, Denis, that as this valuation, share the valuation is rising, the share of earnings that is generated by this sector is actually declining. Other sectors are actually doing better in terms of earnings generation than the IT sector. So this is something that needs to be watched carefully. There was a time back then, and they're saying this sector, the new technology will be deployed very quickly in the economy. I don't dismiss that the deployment will happen, Denis, and help productivity down the road. I'm just not sure that it can happen within 12 to 18 months and that higher interest rates won't hit the sector.
Yeah. But also on the flip side of that, we're seeing that the global factory are not at the level that we should expect, considering what we see in the stock market. And then you have a slide that reflects that.
Yeah, and that, I think that's a cautionary tale because the impact of previous rate hikes is already starting to impact the more interest rate sensitive sectors. Manufacturing is actually in contraction right now. It's a global phenomenon, by the way. It's US, it's Canada, it's Europe, and it's even China. So clearly if global activity slows because of higher interest rates, there's going to be less earnings going forward. So this is why we have to be careful with the multiple expansion purely driven on the assumption that IA will be quickly deployed in the economy. Those valuations are not cheap, Denis. I think we have to be careful. Plus, Denis, I want to come back on something you said last time. With the debt ceiling story now behind us, the U.S. government will be issuing a massive amount of government bonds in the second half of this year. I think it's $1,000 billion. That's $1 trillion. Yeah. And I don't know for you, but I doubt that the market is fully pricing the overall impact.
I think they can't. I think they have a sense of, yes, that volume will hit the market, but that dollar value will hit the market when they will issue. Then we will see the impact. And you know, in the past, I think we were kind of fooled by the central bank buying all the paper. Now they are in the QT, they are not in the QE, then they won't buy that paper. Then it means it's everybody, you know, all the institutional will have to buy it, the pension fund and insurance company, and this is a lot, okay? And that will have an impact, and probably the yield curve will get steeper because of that.
And you mentioned QT, but you know, with China slowing down, they're also going to be less aggressive in buying U.S. treasuries given the complex geopolitical backdrop. So maybe that argues for more volatility because the 10-year treasury yield could rise again back above 4% in the coming months. So I think we have to be very careful on that front. So yeah, it's a complex environment and against a backdrop where the valuations are definitely not cheap for the stock market. So yeah, we have to be careful out there.
Thank you for being with us, and we'll see you next month.